I'm going to go ahead and get started. It's a few minutes after 7. It's down to just in the low 80s today in Kansas, so with it 20 degrees cooler, taking advantage of the opportunity to clean the garage. So thank God this came along in time to save my life. It was getting hot. Okay, so this is Ken Long from Tortoise Capital with the review of the weekend reports for July 7th, 2012. Start off with the strategy report. We're in bullish normal conditions. I forgot to update this piece. It says bull volatile. That should read bullish normal. We're at 56 out of 100 on weekly RSI, so in the just above the 50-yard line. On the 10-day NDX, we're pulled back to 67 out of 100, so still in neutral conditions on a short-term basis. Percent stretch above the 200-day moving average is 4.38%. It pulled back a little bit, which still makes it white bullish, but it gave up a little bit of territory this week. Slope of the 50-day moving average, however, has improved to minus 0.10%, which is yellow neutral, so it's improving. Last week, you may recall, it was still in the red. ADX has improved slightly to 18.7, up from about 15 from last week. Still neutral, still plenty of room for it to go if this bull can keep going, this little rebound. ATR percentage has pulled back a little bit to 1.36%. It was up around 1.5, you'll recall, last week, which made it on the edge of normal. Now it's down into the high normal. No change in the 26 or 13 ETF portfolio. Next reevaluation of those is due on or about 1 August. In ETF2, the theoretical exposure was reduced to 10%, and the model portfolio remains at 50% exposed. We'll take a look at the blended monthly rebalancing next. See what we can see from the portfolio stats there. Waiting for that to come up on your screens. So in the 13 ETF portfolio, we have 3 that are on a buy signal: Treasuries, U.S. real estate, and the U.S. small caps. Everything else is on a cash. It's the U.S. In front of the global still. On the 26 ETF portfolio, we got Treasuries, real estate, emerging market bonds, agriculture, short bonds, U.S. small caps, followed by the rest of the U.S., and then the globals, and Brazil, Latin America, and the BRIC countries are really lagging right now. So no real change to the leaders and the laggards from what we've seen over the past 3 or 4 months, actually. Next up is the market health check. Let me let that come up on your screen. All right, where our vertical blue lines represent 10, 20, 30 days of look-back period. Horizontal purple lines are the resistance lines from previous bullish moves to the upside. The horizontal red lines represent support levels that have held in the past. The blue shaded area in the middle is the 30-period Bollinger Band with plus or minus 1 standard deviation. The center line, of course, would be the 30-day simple moving average, which is the middle of the river. The horizontal black line is the 30-day regression line. The outer black lines represent the maximum excursion from that regression line. That's the regression channel. It's offset by 1 day, so we can put today's price action into context. The blue extensions are the Andrews pitchfork, which just allows us to extend those regression lines forward. And the shaded red area is the 200-day moving average, is the solid red boundary, and then underneath that is the would be bearish territories. All right, so what we have is price made it a little higher this week, up to almost 138. 3/4 of the way through the regression channel. I see a set of 1, 2, 3 higher lows. Made a new swing high. Started to pull back Wednesday and Thursday, short of this 138.5, which we've identified as a critical price target level. So we really want to see it make a higher low than 131 on this next pullback, and then take out this about 138.5. It really needs to get above about 141 to be really bullish and to have cleared the previous swing high that goes back to March. Still, this is favorable price action here. The selling days were fought back to the close in each case, so long tails to the downside. So there's still buying pressure in this market. You can see the 10-period moving average has crossed over the 50 and is rolling up. The slope of the 50 is improving. You can see the river starting to expand with upward volatility. To the upside, the river is rolling over here and starting to hook back up. So that's favorable. We've still got a nice 4.5% cushion between price and the 200-day moving average, which is moving up relentlessly. You can see ADX is starting to improve. It got down to around 15 earlier in the week, and then with the big gap up on Monday, the bulls jumped out in charge. And so right now, the trendiness is still low, but it favors the bulls, so this could still be the beginning of something nice, really to counteract that harsh sell-off. It went from 140 to 127. We've crawled back up to almost 2/3 of the way back up. We just pulled out of overbought conditions on the Williams %R, and the jaws of PPO, the percent price oscillator, open pointing upwards. Although you can see the last couple of days we started to lose some momentum, but it did not look like panic selling. Didn't feel like it. It held the Monday's gap. So now it gets really interesting at this 135. If 135 continues to act as support, then a run at 138.5 and then 141, 142 looks reasonable. But a failure at 135 means that this gap is now in question, and then I would see the target being back at 133 pretty quickly, and then the next significant price target to downside just about 130.5. So you can see the little price ladder going in both directions. Still slightly favoring the bulls, but again, as a trader, this is optimal time frame. Lots of dojis, and we're right in the middle of this regression channel, so it's a nice 2 to 3 day move to the boundaries of the regression channel for short-term trading, and then it's got to break out of those to be a significant longer-term trend. So slight favoring to the upside right here. Next up is the ETF2 report, the top 10. Let me let that come up on your screen. What you'll see is that 9 out of the 10 indexes are on cash signals, which is why we're at 10% invested, 90% cash in the theoretical model. And the only index that's on a buy signal is the U.S. Small caps, as you can see here. So 1 out of 10 are on a buy signal. That's why we're at 10% invested, 90% cash. SPY is still better than EFA. SPY at 63 aggregate here is better than 48 on the aggregate. And among the U.S. indexes, there's a slight tip of the hat to the techs over the large caps, over the small caps, with the U.S. mid caps bringing up the trail in the U.S. And then the two strongest are techs and U.S. large caps, two weakest Latin America and emerging markets. So little to no change compared to last week and really over about the last 3 to 4 months. Moving on. World market model up next. All right, in the world market model in the U.S., you'll see that just about all of the U.S. is above average right now. Only the mid-cap growth is lagging just a little bit, but otherwise the U.S., anywhere in the U.S. is looking better than the entire Asia region or the European region or markets. So it's all U.S. and it remains that way. Inside the Asian countries, still Singapore leading the way, followed by Malaysia and Hong Kong. China's still the big laggard here. Mexico better than Canada, better than Brazil, maintaining that relationship. You can see Latin America still suffering here. Inside the business sectors, let's see. Yeah, inside the business sectors, you'll see it's the defensive plays. Staples, utilities, and healthcare are stronger in the U.S. and globally. And the basic economic producers, materials, energy, finance, industrials, still lagging considerably, both in the U.S. and globally. Moving on. The ETF top 30 from the ETF2 database. Little to no change among the leaders. Home construction and biotech. PCY, this emerging market sovereign debt, is up there as our the real estate REITs of any type. Really, you see the iShares, Vanguard, the Dow Jones Wilshire REITs, Cohen and Steers, Realty Majors, Dow Jones, U.S. Real Estate. Should be getting the idea that real estate is kind of working right now. The first XL series, we got the sector spider is Staples, continues to do well, followed by the defensive play pharmaceuticals, financial prefers, then retailers. So everything looking really about the same as last week, favoring real estate in the U.S. large caps that can earn money, mature companies that are earning money. That's a conservative risk-on trade that favors the U.S. Next up is the Dow 30, using the same lens. And what you'll notice here, again, it's the consumer staples. Walmart, Verizon, Disney, Coke, Home Depot, Merck, Johnson & Johnson. At the bottom, it's the producers, once more, Hewlett-Packard, J.P. Morgan, Caterpillar, McDonald's, Alcoa, Procter & Gamble. The productive sector just not getting it done. Defensive plays continuing to be rewarded. Moving on. Just taking a quick look at volatility here. We pulled back into the range of normal on a long-term basis, so you can see that this is still at the very, very low end of volatility on a 5-year historical basis. Even though we have slowly increased short-term, by historical measures, this is still right around the boundary of normal. All right, we're going to shift now to the daily. All right, so let's see. On the gap stat, we'll take a look at the gap up days. 16 times in the last 30 days, the market has gapped up. 5 of those days, the gap up is reversed to close sharply lower for an average of minus 1.18. 11 out of 16 times, so a little more than 2/3. That gap up has continued to gain for an additional 0.58. That's a pretty clear and distinct difference between the gap up and fails. That if you can get an early entry into those fails, that has been a lucrative trade. Let's see, short signals in EPP and ILF. I would look there for confirmation from the U.S. market to see what SPY is doing. If SPY has fallen through 135, you know that there's a $2 move for it to close the gap to the downside, and then that looks like a low-risk trade for this EPP and ILF short. But I would wait for market confirmation first. You can see the 10-day max pains, JP Morgan, Hewlett Packard, Bank of America, Intel, DuPont. In the ETFs, VIX, natural gas, gold miners, Germany, and silver. 10-day min pain, these have been the winners: Walmart, McDonald's, Procter & Gamble, Johnson & Johnson, 3M. The dollar up, corporate bonds, European, and then some bond funds here. In the pattern trades, we have only DuPont on a channeling and AT&T on a 551W. And then Auto Framer, quite a few targets still. JP Morgan, the VIX, European 350, Silver, Euro Asia Blend, and the energy sector spider all test out at better than 2-to-1 on the Auto Framer. Quick look at the Dow 30 Tactical. A number of dojis: JP Morgan, Pfizer, Procter & Gamble, Boeing, American Express, and Chevron. Here's the channeling signal on DuPont and the 551W and AT&T. Only JP Morgan tests out at better than 2-to-1 on the Auto Framer, but that's at 5.2, and it's the number one max pain range compression, and it closed as a doji, and it has a 7 on an RSI 2. So JP Morgan looks like a very interesting target. We might also look at Bank of America as the number 2 and then max pain range compression, and then IBM, which had a 7 on the RSI 2. So JP Morgan looks to me to be very interesting. So we'll take a look at that one on the stock charts in a minute. All right, next up, the ETF 30. While we're waiting for that to load up, I would just also just observe, look at Walmart here. This was one of those min pains. It had a breakout day on Friday when other things were suffering or neutral, and it has been outperforming its peers on every measured time frame, and had a big day on Friday. So Walmart is sort of a natural one for a continuation play. Okay, next up is ETF 30. through the same lens. Only 4 dojis here. Russell Mids, the Euro-Asia Blend, and XLB, the S&P Materials. 5 on the auto framer. No patterns to speak of. The VIX Silver European 350, the Euro-Asia Blend, and the Energy Sector Spider all test out at better than 2-to-1 on the auto framer, so that looks interesting. You can see the nice gains in agriculture DBA, which is 3.0 on the frog scale, which is nice. Moving on. Looking at the market mosaic, no surprises here. Waiting for it to come up on your screen. There we go. You can see the regression line still facing up, still well ahead of its 10-period moving average on the zoom in here. We've had almost a 3 sigma move off the turnaround from 127. You see the slow and steady, if choppy, improvements in price relative to the 200-day moving average. But it's been a lot choppier here than it was on the run up. So this is looking more like those beginning moments of that previous nice run at the start of the year. So if it can get out in front of this previous swing high around 141, that's sort of what's needed to get us back up into this high altitude. All right, moving on. Next up, the z-scores of regression lines. Waiting for it to come up on your screen. Here we go. All right, so the 10-period regression line is out of its little channel, as a z-score better than 1. The 30-period is about ready to join it as a defined trend to the upside. Even the 90-day z-score has rolled over, and that'll support an upward move here as well. You can see on the price compared to the river, it bottomed out after a harsh sell-off and a lower low. It charged through across the river, peaked out, came back, stayed in the river, and then made a higher high. It's now back to the edge of the river. This is sort of about where you would expect it to find support in order really to turn that river and make it start running north. Those 3 higher lows, 142, 141, and now about 136. We're in good posture here for another leg up to contest 142. We're well across the river. You can see now how it has started to turn and roll back to the upside. So that's favorable. All right, next up. That's everything I wanted to look at on the daily reports. Let's shift over now to, let's see if we can't find, let's see, we wanted to look at, I think JP Morgan. All right, this is nice. It had a nice run up, found support. The big red candle in a doji may have shaken out any of the weak hands over the last 2 weeks. The doji gives you an attractive entry point, 5 cents above that. Looking to play to the top of the 10-day trading range around 37. And the doji is so small, that's why you end up getting almost a 6-to-1 reward to risk ratio here. I think that's a very low risk idea. There was one day of panic selling, but Friday's price action was almost disinterested. So that could be favorable. Okay, just a study I'm doing as part of this next core workshop I wanted to share with you. Let's take a quick look at some information here. One of the things that I do is examine, the data on what kind of returns are available based on the length of your holding period. In order to try to define the difference between normal and abnormal gains and losses. So I went back 10 years, looking at symbol SPY. So that's something like 2,600 trading days. And computed, we'll start from the right-hand side, looking at the daily, each one of those 2,600, the one-day returns, if you bought the close and sold it on the next close mechanically. On average, that was flat, 0.03%. The single worst one day was in SPY was minus 9.85%. The single best one day was 14.51%. The standard now what's more interesting is the standard deviation of 1.34%. And what that means is that the loss on the downside there, that minus 9.85%, is a 7 1/3 standard deviation adverse move. And the upside move was almost 11 standard deviations. It's an unbelievable number. The plus or minus, you notice here, this is sort of the bound of normal, that the range of normality over the last 10 years for one-day performances in the S&P was between 1.37 and minus 1.31%. So as you start moving out towards the other end, let's zoom all the way out to day 40. And say now there are something like 2,560 40-day holding periods in the market in the last 10 years. And so if you computed each one of those 40-day holding periods, you see the best holding period for over 40 days was almost 34%. The single worst 40-day period was minus 37.5%. With the standard deviation of 6.79%, that gives you an average of 1.03, and then a plus or minus of the standard deviation gives you these one standard deviation bands of normality. So it's normal to have a holding between plus 7.8 and minus 5.76 in S&P. The minus 37% was a 5.68 sigma adverse move, and the 34% gain on the upside was a 4.84. So what I want you to notice is just is the magnitude of the adverse moves that you're seeing. Pretty remarkable. And the downside is typically worse than the upside. In fact, the only place where it's not the case was on the one-day time frame. Now, if we were to convert that to a slide just for comparison purposes, let's take a look at it in another way. Here we go. as a point of comparison now. The range of performance is then on one day. It looks like this little doji between 10.8 and almost minus 10%. And the range of normal, look how thin that plus or minus 1 standard deviation range is compared to the extreme width of the tails. As you start moving out the time frames, you don't have a uniform increase in the size of the range of variability and a little wider range of what is constituted as normal. So what that tells you is as you start moving outwards, although the absolute values change, the error factor, which is the relative size of the wicks, is getting smaller. And now so although the ranges of pluses and minuses of what can be experienced are much wider over 40 days, given the one-day variation, what's interesting to note is how the sigma reduces as you move out the time frames. That whereas on the one day you go from almost 11 to a minus 9 3/4, a 20 sigma difference, you notice that it gets smaller and smaller out here, so it's plus or minus 5 sigma on 40-day holding periods. Still an extraordinary number, and which renders the price information non-normal for forecasting purposes. But what this says is that volatility-based instruments and systems make a lot more sense as you shorten up your time frame. You have to take into account the effects of volatility even more carefully in shorter-term systems. Let's see. We'll pick a couple, maybe take a look at a couple, we have some time here. Take a look at a couple representative trades from this week. This was a nice one on, let's see if we can zoom it up a little bit here. There we go. All right, so this was a regression line crossover trade on, this looks like Thursday, July 5th, TNA. What we had was this was the opening, sold off harshly, had like a little morning hook. Where I ended up buying this one because the regression line crossover happened inside the river. Ended up waiting to see it get to the mean, pull back, hardly any sell-off, and then start taking off again. So upon this narrowing of this little 2-period Bollinger Band and starting to tick up again, there was no failure on this one. It failed to fail further. So after this gap up and then sell-off, big bounce down, bounce to the mean, this is where I would expect it to fail if today was going to be a down day. But it didn't fail. Failure to fail is information. It held support above the Bollinger Band mean. The VWAP had gone sideways and was just getting ready to start hooking back up. So I ended up buying this at 57.66 with a 30-cent stop. And then it takes off. It gets a little back in the fill in here. But the 10-period regression line hardly budged. Once it left the river, made a nice run up all the way to 58.40. And there it horsed around for just about 15 minutes, offering exits at 58.40. On this second green circle, I took a second entry at 58.30. And here's why. I already had a couple R in hand from the first trade. Price and the 10-period regression line had both exited the river, and this one took out the previous swing low here, or swing high, at 58.25. So I get a nice entry at 58.30. But almost shortly thereafter, it just flatlines and starts going sideways, and after about 15 minutes, this was beginning to decay, and price was pulling away from that 10-period regression line. So I ended up taking the exit shortly thereafter at 58.40, which nets out to 2.7R. Sort of a bread and butter kind of a trade. No runaway follow through to the upside. Now, I say that in order to then say, here's what happened next. Well, let's see. All right, so shortly after this, the first leg of this trade up, as you may recall from the last one, was entry here, second entry up here in this extension, then it failed to go any further, and so cashing it at 58.40 here. And now the next target is a retracement back to the mean. It doesn't do that. It has a little bit of a failure, but then it finds support at 58.30 and rolls over and starts going up again. So that's what the heck. By now, we have a regression line crossover to the upside, and now everything is out of the river and pointing north, and I'm just sort of required to buy that. So we get the re-entry at about 58.40 with an initial stop of an I stop of 0.3, which would be 58.10, which is well down into the river. Let's see what we have. Now I'm looking for the follow through on that one. Oh, okay. And then this is one of those where the follow through doesn't happen. And so the entry on the second piece was 58.40 with an initial stop of 0.3. However, after about 10 minutes, it fails to follow through, and even the 10 period starts to roll over. As soon as the 10-period regression line comes back into the 2-period Bollinger Band, that's just telling me, hey, failure to follow through, tighten up my stop just in time to get it exited at 58.25 and taking a professional loss of half an hour right there. So that's just one of those, hey, here was a nice move on a slow, sluggish day after the Independence Day. No follow through, better to take the short loss and move on. Keep your powder dry. Okay, so that's everything I want to talk about this weekend. I'll have this the recording done and try to get that hung on YouTube tonight now that the internet's working a little better. I do want to show you this. There was some discussion of some internet glitches tomorrow, and let me just show you what that's about. If you take a look at this this website, there was some malware that was floating around and causing people to get their DNS service, the one that looks up the address book, getting it diverted. And so if you just go to this this website up in here, this dns.ok.us, so www.dns-ok.us. That is a server that's set up to scan your machine by the FBI just to make sure that you're not infected by this malware. It takes about 2 seconds to get it done. So I'll leave that up there for a second for you to take a look at. You're welcome, Mike. After I get through updating the core, I'm trying to record a home study version of that one. I'm going to try to get the regression line crossover observations, at least on paper. It's starting to mature up pretty nicely. Bill Brower's making progress on the blended monthly rebalancing. We may not be able to, because of some peculiarities of TradeStation, we may not be able to combine the ETF2 weekly tool into the same strategy as the blended monthly rebalancing and still preserve the back testing. So What we'll probably end up doing is just making that a two separate strategies, and I'll just put them in the same bundle as two different tools. It's problematic to mix monthly and weekly strategies in TradeStation, and if Bill Brower finds it problematic, then probably it's pretty hard to do. But we're looking at doing the frog bundle after that one, and then regression line crossover there. The simulator IITM is putting together for the frog boot camp looks pretty good. We're putting together the sample trades out of the last year to make sure that we have all different kinds of daily price action to explore the frog with. People in that workshop will get 100 hands-on frog trades, measured performance against, what the mechanical rule set will be, so we can see how their trader quality number looks. So that's a brand new kind of workshop for IITM, and one I'm looking forward to doing. And that's going to be in early August. I think there's 18 people in it already, so I think it's pretty close to filling up. If it works pretty good, I'm looking to do some more of that to include the regression line crossover strategy and the sideways quiet channel breakout. If the simulator supports mechanical frog trading, then I think we can do some of that kind of intensive practice on just a single strategy over the course of a weekend. That way, it's not a full week of live trading. That looks to me to be a nice bridge to the live trading week. So, a weekend we're looked at the rule sets, and then maybe another workshop where we're doing 100 practice trades as a way to really cement the learning. That looks like a nice way to go after these systems. So more to follow on those. I'll keep you posted. But that's all I got for tonight, and hope you guys have a good week ahead. Take good care.